Imagine waking up every single morning, checking your brokerage account, and seeing that a company just paid you $10. They didn't pay you for your time, they didn't pay you for your labor. They paid you simply because you own a tiny piece of their business. $10 a day might not sound like quit your job and move to a private island money, but $10 a day is a free Netflix subscription, a free coffee, or your phone bill completely covered. It's $3,650 a year of completely passive income. And more importantly, it is the crucial first milestone on your journey to total financial freedom. Welcome back to Sara Trades. If you are tired of trading your hours for dollars and you want your money to start working as hard as you do, you are in the exact right place. Today, I am giving you the ultimate step-by-step masterclass on how to build a beginner-friendly dividend portfolio from scratch. We are going to cover the exact math to get to $10 a day, the best U.S. brokerages to use, the tax accounts you need to know about to protect your money from the IRS, and the exact types of ETFs and stocks you should be looking at. Grab a notebook because this is going to be a deep dive. Let's get into it. The math behind $10 a day. Before we buy a single stock, we need a roadmap. We need to know exactly how much capital it takes to generate $10 a day. To do this, we need to understand a simple concept called dividend yield. The dividend yield is simply the percentage of a company's stock price that it pays out to you in dividends each year. If a stock costs $100 and it pays you $4 a year, that is a 4% yield. Now let's reverse engineer our goal. $10 a day multiplied by 365 days in a year is $3,650. That is our annual target. Target $3,650/year portfolio yield. 3% equals $121,666 invested. Portfolio yield 4% equals $91,250 invested. Portfolio yield 5% equals $73,000 invested. Look at these numbers. If you build a safe, reliable portfolio with an average yield of 4%, you will need exactly $91,250 invested to hit that $10 a day mark. I know what you are thinking. Sara, $90,000 is a ton of money. How is this beginner-friendly? Take a deep breath. You do not need $90,000 today. Dividend investing is a snowball effect. You start with $100. That $100 pays you $4. You take that $4 combined with your next paycheck and buy more stock. Then you get paid $8, then $20, then $50. Through a magical process called compounding, which we will talk about later, your money accelerates. The goal today isn't to deposit 90 grand. The goal today is to lay the foundation so that every single dollar you save goes to work for you. All right, step 2. Where do we actually put this money? In the United States, we are incredibly lucky because we have tax-advantaged accounts that can shield our dividend income from Uncle Sam. If you just open a regular taxable brokerage account on Robinhood or Webull, every time you receive a dividend, you owe taxes on it. For most of you, qualified dividends will be taxed at 15%. That slows down your snowball. This is why your best friend as a dividend investor is the Roth IRA. A Roth IRA is an individual retirement account. You fund it with money you've already paid taxes on, like money from your paycheck. The magic happens inside the account. Any stock you buy, any dividend you receive, and any capital gains you make inside a Roth IRA are 100% tax-free forever, as long as you follow the withdrawal rules after age 59 and a half. If you want to build a massive dividend snowball, you should heavily consider maxing out your Roth IRA before investing in a standard taxable account. For 2024, the contribution limit is $7,000 a year. So, which brokerage should you use? Keep it simple. I highly recommend established trillion-dollar brokers that offer fractional shares and zero commission trading. Fidelity and Charles Schwab are my top 2 picks for beginners. Their platforms are incredible, their customer service is top tier, and most importantly, they allow you to automatically reinvest your dividends for free. More on that later. Action step for this section. Pause this video, go to fidelity.com or schwab.com, and open a Roth IRA. It takes exactly 5 minutes. Now that our account is open, it's time to go shopping. But before you buy a single stock, I need to warn you about the most dangerous mistake beginners make. It's called the yield trap. You will log into your broker, sort stocks by dividend yield, and see some random company paying a 12% or 15% yield. Your eyes will light up. You'll think, wow, if I buy this, I only need $24,000 to reach my $10 a day goal. Stop. Don't touch it. Remember the formula? Yield is the dividend divided by the stock price. Usually, when a yield is sitting at 10% or 15%, it's not because the company is generous. It's because the stock price is crashing, and Wall Street knows the company is going to cut or cancel their dividend soon. A high yield is often a red flashing distress signal. To avoid the yield trap, we are going to use 3 golden metrics to evaluate every single stock. Metric number 1, the payout ratio. This tells us what percentage of a company's profits are being paid out as dividends. If a company earns $10 per share in profit and pays out $5 in dividends, their payout ratio is 50%. Rule of thumb. Look for companies with a payout ratio under 60% or 70%. This leaves them plenty of cash to reinvest in their business, pay down debt, and survive economic recessions without cutting your dividend. Metric number 2, dividend growth history. We don't just want a dividend today, we want a dividend that grows every single year. Inflation makes your groceries and rent more expensive every year, right? Your dividends need to grow to keep up. Look for companies that have increased their dividend for at least 10 consecutive years. Metric number 3, free cash flow. Dividends are paid in cold, hard cash. You want to see a company generating a massive, growing amount of free cash flow. If their free cash flow is shrinking but their dividend is growing, they are borrowing money to pay you. That is a ticking time bomb. Okay, we know the math, we have the account, and we know the rules. Let's build the actual portfolio. For beginners, I recommend a 3-tier structure. We are going to build a pyramid. The bottom will be broad, safe ETFs. The middle will be individual blue-chip growth stocks, and the top will be our high-yield real estate boosters. Tier 1, the foundation, 50% to 60% of portfolio. At the base of your pyramid, we are not picking individual stocks. It is too risky for a beginner to put all their money into one company. Instead, we are using exchange-traded funds, or ETFs. These are baskets of dozens or hundreds of stocks bundled into one ticker symbol. The crown jewel for dividend investors right now is SCHD, Schwab U.S. Dividend Equity ETF. SCHD tracks 100 of the highest quality dividend-paying companies in America. Companies like Home Depot, Texas Instruments, and Amgen. It strictly filters for companies with strong cash flow and at least 10 straight years of dividend payments. Historically, it offers a yield around 3.5%, and more importantly, its dividend has grown by over 10% per year over the last decade. Another great option here is VIG, Vanguard Dividend Appreciation ETF, which focuses on dividend growth, or DGRO, iShares Core Dividend Growth ETF. Pick 1 or 2 of these to form the absolute bedrock of your portfolio. Tier 2, Dividend Kings and Aristocrats, 20% to 30% of portfolio. Now we move to the middle of the pyramid. This is where you can pick individual companies that you know, love, and use every single day. We are looking for dividend aristocrats, companies in the S&P 500 that have raised their payout for 25 consecutive years or more. Let's look at a classic example. Coca-Cola, ticker symbol KO. They have increased their dividend for over 60 consecutive years. Through the dot-com bubble, the 2008 financial crisis, and the 2020 pandemic, Coca-Cola kept cutting checks to their shareholders. When you buy Tier 2 stocks, you are buying peace of mind. Other great examples to research include Procter & Gamble, PG, Johnson & Johnson, J&J, and Lowe's, LOW. Tier 3, the income boosters, REITs, 10% to 20% of portfolio. Finally, the top of the pyramid. We want to boost our yield a little bit to get to that $10 a day faster. To do this, we are going to look at real estate investment trusts, or REITs. By law in the United States, REITs are required to pay out at least 90% of their taxable income to shareholders in the form of dividends. Because of this rule, they usually offer much higher yields, often between 4% and 6%. The absolute gold standard in this space is Realty Income, ticker symbol O. They literally trademarked the phrase, the monthly dividend company. Unlike most U.S. stocks that pay you every 3 months, quarterly, Realty Income pays you every single month. They own thousands of commercial properties leased to rock-solid tenants like 7-Eleven, Walgreens, and FedEx. Crucial tax warning. Remember when we talked about the Roth IRA? REIT dividends are usually taxed as ordinary income, meaning they get taxed at a much higher rate than normal stock dividends. You absolutely want to hold your REITs inside a tax-advantaged account like a Roth IRA to avoid a massive tax bill. You have your portfolio built. You have SCHD, some Coca-Cola, maybe some Realty Income. You are ready to sit back. But there is one final setting you must turn on inside your brokerage account if you want to reach $10 a day in record time. It's called DRIP. DRIP stands for Dividend Reinvestment Plan. When you turn this on in your Fidelity or Schwab account, you are telling your broker, hey, when Coca-Cola pays me a dividend, do not leave it as cash in my account. Immediately use that cash to buy more fractional shares of Coca-Cola. This is the holy grail of investing. It creates an automated compounding machine. Let me show you the math. Let's say you own 100 shares of a stock paying $1 per share. Year 1. You get $100 in dividends. You DRIP it. Now you own 105 shares. Year 2. You don't just get paid on your 100 shares, you get paid on the 105 shares. Plus, the company raised their dividend to $1.10. Now you are making $115. You DRIP it. Now you own 112 shares. Do you see what is happening? Your dividends are buying more shares, which produce more dividends, which buy more shares. It is a snowball rolling down a hill, gathering size and speed without you having to lift a single finger or invest another dime of your own money. Never take your dividends in cash while you are in the wealth-building phase. Always, always DRIP. Now the step-by-step execution plan. All right, we have covered a massive amount of ground. Let's condense everything into a clear, actionable 5-step checklist so you can start right this second. Step 1. Open the right account. Go to Fidelity, Schwab, or Vanguard. If you qualify based on your income, open a Roth IRA to protect your future wealth from taxes. Step 2. Set your budget. Figure out exactly how much you can invest consistently. It doesn't matter if it's $50 a week or $500 a month. What matters is that it is automated. Set up an auto transfer from your checking account to your brokerage account the day after you get paid. Pay your future self first. Step 3. Build the core. Take 50% to 60% of that money and buy a high-quality dividend ETF like SCHD or VIG. This gives you instant diversification across the U.S. economy. Step 4. Layer in aristocrats and REITs. Take the remaining money and buy high-quality companies with decades of dividend growth. Keep your payout ratios low and make sure your REITs like Realty Income stay safely tucked inside your Roth IRA. Step 5. Turn on DRIP and wait. Toggle the dividend reinvestment switch in your account settings. Then, go live your life. Go focus on your career, your family, your health. Let the companies and the magic of compound interest do the heavy lifting for you. Getting to $10 a day in dividends is going to take time. It might take you a few years to build up the capital. There will be months where the stock market crashes and your portfolio value drops. When that happens, I want you to remember this. As a dividend investor, a market crash is just a sale. If Coca-Cola's stock price drops 20%, but they don't cut their dividend, that means their dividend yield just went up. Your $100 buys you more shares, which buys you more passive income. Stop looking at the daily stock price and start tracking your monthly dividend income. As long as that income is growing, you are winning the game. If this video helped you understand how to build a passive income engine, please hit that like button. It massively helps the channel out. And if you want to keep learning how to take control of your financial future, make sure you subscribe to Sara Trades and hit the notification bell.